Hey, welcome back to the channel, everyone. Before we dive into today's breakdown, make sure you hit that like button, subscribe if you haven't already, and tap the notification bell so you don't miss any updates. The support you show really helps this channel grow and keeps me motivated to bring you deep dive analysis on stocks that the mainstream media often ignores until they're already up triple digits. Now, let's get straight into it, because today we have some absolutely explosive news surrounding Opendoor Technologies, a company that's been at the center of both bullish speculation and bearish doubt for months now. Opendoor closed the regular trading session down 4.09%. On the surface, that doesn't look great. Many casual observers who only glance at the closing numbers might assume the stock is rolling over or losing steam. But if you zoom out, the picture is very different. This decline wasn't really about Opendoor itself. It was largely a function of the broader market selling off. Risk assets across the board were under pressure, indexes were red, and when that happens, high beta names like Opendoor often get pulled down even if there's no company-specific catalyst. And as always, one final note, this is not financial advice. I am not your financial advisor. This content is purely educational and entertainment-based. Always do your own due diligence, consult with a licensed financial professional, and never invest money you can't afford to lose. What makes this session fascinating is the volume profile. We saw roughly 338 million shares traded, compared to an average of 310 million. That might not sound like much, but in trading terms, it's significant. Elevated volume during a red day tells us that there was heavy positioning happening beneath the surface. This wasn't just retail traders casually buying and selling. It was large-scale repositioning by institutions, hedge funds, and active traders who wanted exposure before the next catalyst. And then, right after the closing bell, everything changed. After-hours explosion and why it matters. In after-hours trading, Opendoor skyrocketed 35.15%, hitting highs of around $8.58. That is not a small move. For a company of this size, those are the kinds of gains that completely reset market sentiment, squeeze shorts out of their positions, and bring in massive retail interest the following day. After-hours moves like this are especially powerful because they happen on lighter volume, meaning that even moderate buying pressure can send prices higher and cause short sellers to panic when they realize they're on the wrong side of the trade. So what was the catalyst behind this? The catalyst: new CEO appointment. The long-awaited CEO announcement finally dropped. Opendoor named Cass as its new Chief Executive Officer. Now, Cass isn't just some random hire. Cass previously served as the Chief Operating Officer at Shopify, one of the most successful e-commerce platforms in the world. Shopify scaled from a small Canadian startup into a global giant, disrupting retail and empowering millions of businesses. That kind of background matters because it signals that Opendoor is serious about operational execution, efficiency, and scaling. Investors for months have been saying the same thing. Opendoor needs a real leader. The company had incredible technology, a disruptive business model, and strong long-term potential, but without strong leadership at the top, it felt like a ship without a captain. That uncertainty was one of the main reasons shorts piled in. They saw a company with no clear direction, burning cash, and vulnerable to housing market cycles. But now, that entire narrative shifts. With Cass stepping in, investors suddenly have a leader with proven experience in scaling a disruptive business model. Insider confidence, pipe financing. But that's not the only part of the story. Alongside the CEO news, Opendoor also announced that Colossa Ventures and co-founder Wu are rejoining the board and backing the company with a $40 million PIPE, private investment in public equity financing. Now, PIPE deals often fly under the radar, but they're incredibly important. They allow companies to raise capital quickly, often with institutional investors getting shares directly at negotiated terms. While we don't yet have the SEC filings to break down the exact structure, the big takeaway is clear. Insiders and early backers still believe in the vision. You don't put up $40 million of fresh money unless you see upside potential. That's a major vote of confidence. And in the stock market, insider conviction is often a leading indicator for retail sentiment. Why shorts are in trouble? Here's where it gets really interesting. While the regular session saw Opendoor drift lower, short interest actually increased by 9.17 million shares net. That's on top of an already massive short float, where roughly 24.78% of the available free float is shorted. Think about that. Nearly 1/4 of all shares available to trade are betting against the company. Now combine that with a 35% after-hours rally, insider buying, and a CEO catalyst. You don't need to be a market genius to see what's coming. A massive short squeeze setup. Short sellers are trapped. Many of them added positions today, thinking Opendoor was about to roll over further. Instead, the stock exploded higher after hours. And as of now, they haven't meaningfully covered. That means tomorrow morning, they'll be forced to decide, do they cut their losses and buy shares back at much higher prices, or do they hold and risk even deeper losses if momentum accelerates? Either way, buying pressure increases. This is how squeezes are born, not from random retail hype, but from the combination of heavy short positioning plus unexpected bullish catalyst plus strong retail momentum. Options market, a pain trade in the making. Let's shift gears into the options market. Normally, when a big announcement is coming, you'll see unusual options activity in advance, like someone knows what's about to drop. But today, that wasn't the case. Before the CEO news hit, the options tape looked relatively normal. In fact, bearish sentiment dominated. Around 55% of options flow leaned bearish, with $42 million in calls traded versus 8.56 million in puts. That imbalance shows that traders weren't expecting a positive surprise. They were hedging downside or outright betting on it. Now those bearish traders are about to feel serious pain. Imagine being the trader who bought $50,000 worth of puts, convinced Opendoor was a scam. Tomorrow, those puts are likely worthless, and the stock is gapping against you. That's how fortunes are lost in a single session. Meanwhile, the relatively small group of bulls who loaded up on calls are about to see their contracts explode in value. From a technical perspective, Opendoor's move is fascinating. After-hours trading pushed shares right into the zone between R2 and R3 resistance levels, with $8.18 emerging as a key pivot point. If the stock can hold above $8.18 tomorrow during regular hours, that level flips into new support. That would establish a base for higher highs, potentially opening the door to double-digit territory. On the downside, $6.58 remains strong support. While I don't expect that level to be tested tomorrow given the strength of the catalyst, it's worth keeping in mind if volatility spikes. Another factor to watch is the potential for new options chains to unlock. With shares now in the $8-9 range, exchanges may begin offering higher strike prices, possibly $15 and above. That creates a whole new playground for traders chasing momentum, which in turn feeds into the feedback loop of rising prices. The macro backdrop, CPI and housing market. Of course, we can't ignore the bigger picture. Tomorrow morning, CPI data drops. Inflation numbers have been one of the biggest drivers of market volatility over the past 2 years. Rising inflation usually means higher interest rates, and higher rates hurt housing affordability, which directly impacts companies like Opendoor. But here's the thing. Sometimes a company-specific catalyst is strong enough to overshadow macro headwinds. That's what we're seeing here. Even if CPI comes in hot and the overall market stumbles, Opendoor has the type of momentum that can power through. Investors aren't buying this stock right now because they're thinking about the Federal Reserve. They're buying because leadership just changed. Insiders are buying, and shorts are trapped. That said, it's still worth monitoring the housing market. Mortgage rates remain elevated, housing supply is tight, and affordability is a challenge. But Opendoor's model, streamlining the process of buying and selling homes, remains disruptive regardless of macro conditions. If CAS can guide the company to profitability and scale, the upside is enormous. Outdated and irrelevant. Another important angle here, analyst coverage. Right now, the highest analyst price target for Opendoor is $4, with the lowest at just 70 cents. The most recent update came in August when a firm raised their target from 250 cents to $4. At the time, that was respectable. But now that the stock has exploded to $8.58 after hours, those targets look laughably outdated. Analysts will be forced to react. They can't keep telling clients that a stock worth $8.58 is only worth $4. That disconnect damages their credibility. So expect to see upgrades in the coming days and weeks. And when analysts revise their targets upward, that often adds fuel to the fire because institutional investors start taking another look. Wrapping it all up, so let's summarize the situation. Opendoor closed down 4.09% during the regular session, but ripped 35% higher after hours. The CEO announcement finally came, with Cass from Shopify stepping in to lead. Insiders showed conviction with a $40 million PIPE financing deal. Shorts added 9.17 million shares at the worst possible time, setting up for a squeeze. Options traders leaning bearish are about to get crushed, while call buyers will see massive gains. Technically, $8.18 is the key pivot with upside potential if momentum holds. CPI data could add volatility, but the company-specific catalyst likely dominates. Analyst targets are way behind reality and will have to be revised upward. This is exactly the type of perfect storm scenario traders dream about. Strong catalyst, insider buying, trapped shorts, and retail momentum. The next few trading sessions could be some of the most exciting we've seen in a long time. Let me know your thoughts down in the comments. Are you bullish here? Do you think shorts are about to get blown out of the water, or are you waiting for a pullback to enter? If you enjoyed this breakdown and found it valuable, please remember to like the video, subscribe for more updates, and share it with anyone who's following the stock. Your support means the world and allows me to keep producing this type of content. And as always, one final note, this is not financial advice. I am not your financial advisor. This content is purely educational and entertainment-based. Always do your own due diligence, consult with a licensed financial professional, and never invest money you can't afford to lose. Thanks for watching, and I'll see you in the next one.